This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hi everyone and welcome back to the channel. Today, I want to dive into a topic that has sparked endless debate. Why did I choose income investing over the standard advice of dollar cost averaging into index funds? The well-known investment educator Felix has stated many times that putting money into covered call ETFs is fundamentally unwise. His reasoning is mathematically airtight. These strategies cap your upside, which almost inevitably leads to lower total returns over the long run. He's provided countless examples to prove it. So, if I understand the math and can't find a flaw in his logic, why haven't I changed my mind? In this video, I want to have a heart-to-heart about my actual, deepest considerations. Before we dive into the heart of the video, I want to take a moment to talk about Moomoo Financial Canada. One feature that really stands out, especially for income investors, is that they are currently offering 0% currency conversion fees between CAD and USD. As many of you know, some of the strongest income-generating products are only available in the US, and those distributions are paid out in USD. For those of you who need to bring that money back into CAD to cover daily expenses or pay bills here in Canada, this 0% FX fee policy is a huge advantage. It allows you to convert your distributions much more efficiently, ensuring that more of your hard-earned money stays in your pocket rather than being eaten up by transaction costs. Secondly, for those who crave a sense of control over their portfolio, the detailed ETF data on Moomoo is excellent. You can find a crystal-clear breakdown of geographic distribution and holdings, and even the dividend history and projections are laid out very clearly. For anyone trying to map out their monthly passive income, having that data organized like a digital pay stub is a massive time saver. Whether you're looking to minimize conversion costs or you just need deeper data to balance household expenses with portfolio growth, Moomoo offers a very practical set of tools. If you're looking for a more efficient way to manage your income portfolio, Moomoo is definitely a choice worth looking into. First, let's talk about a very real sense of survival anxiety. In my view, AI isn't just a tech upgrade. It's an industrial revolution that is reshaping the very foundations of our economic system. Tech stocks will always be the largest part of my portfolio because I truly believe they are changing the world. But here's the brutal paradox. The more powerful AI becomes, the more the average worker's interests are at risk. We live in a world of finite markets, yet AI increases productivity exponentially. Today, one person can do the work of 5. Corporate growth can't possibly outpace the speed of AI evolution, which inevitably leads companies to cut staff in the name of efficiency. We see this playing out in the stock market every day. A company announces mass layoffs, and its stock price immediately skyrockets. If you're a billionaire or a major shareholder, that's great news. But as an average worker, it's hard to celebrate. I'm betting on an AI future, but I'm also worried about whether I'll survive long enough to see it. Recently, reality hit me hard. I lost my job. In today's job market, nothing feels guaranteed anymore. In this state of extreme uncertainty, I'd rather sacrifice some of that paper growth for actual tangible cash flow. This isn't just an investment strategy. It's my last line of defense against the shocks of our time. I don't even know whether to feel sad about losing my job or relieved that I had the foresight to build an income investing portfolio. We need to debunk a myth. Do growth investors actually get better results in reality? The growth investor model is usually based on a perfect mathematical scenario, that the same dollar in the same asset will almost always outperform the covered call version. That's true on paper, but it ignores the most important variable, the human being. Most people, myself included, are imperfect investors. We want to bail when the market crashes and sell as soon as we break even. These are deep-seated human instincts. I still remember when I was purely in index funds, I'd always feel the market was too high and keep at least 30% of my portfolio in cash. As a result, I'd watch the bull market leave me in the dust, constantly sitting on the sidelines. Ironically, many growth investors end up being more conservative than income investors. They call it position management, but it's often just a lack of psychological fortitude that leads to missed opportunities. In contrast, an income investor can actually be more aggressive, and I mean that in a positive way. When you see your money literally generating more money every month, you gain the conviction to stay invested. Even if the market crashes, your first instinct isn't panic, it's excitement. Why? Because as prices drop, your distribution yield goes up, making you more eager to buy. That mature investor mindset is something many books try to teach for years, but income investing achieves it naturally through its monthly distributions. Furthermore, covered call ETFs have evolved. Funds like HYLD, HDIV, and QQCL now use about 25% leverage. That leverage helps bridge the performance gap with the underlying assets. Even if there's a slight lag in a raging bull market, the psychological peace of mind is worth more than that gap, because it's what allows you to actually stay in the game. Let's talk about the true tolerance for volatility. People love to say, as long as I don't panic sell, growth is better. But that's often an idealized fantasy. Take HDIV, for example. It has performed incredibly well, even outperforming XEQT, XIU, and VFV. I'm sure if you held the underlying assets of HDIV without the covered calls, the returns would be even higher. But the real question is, would you actually have the guts to hold that concentrated of a portfolio? The people who criticize covered call ETFs the loudest are often the ones hiding behind ultra-diversified, safe, broad market funds like XEQT. There's nothing wrong with XEQT, but its popularity reflects a fear of volatility. If a fund provider released the exact underlying assets of HDIV but removed the yield, most people wouldn't touch it because it would feel too concentrated or too risky. At the end of the day, everyone has a limit for volatility. You might say QQC with no covered call is better than QQCL, but would you actually put your life savings into QQC? Probably not. You'd stick with XEQT. QDay's underlying QMVP index has amazing growth potential, but without the distribution buffer, how many growth investors would actually hold it through a 30% drawdown? I find it absurd when people compare a 25% leveraged fund like QQCL to something like QQQL, which is also 25% leverage and mock QQCL for underperforming. This comparison completely ignores the role of covered calls in dampening volatility. The reality is that even if QQQL has better paper returns, it remains a niche, cold ETF because most people simply cannot handle that level of heart-wrenching volatility. Investing isn't a math proof in a lab. It's a psychological battle in the real world. Income investing is powerful because it uses constant cash feedback to artificially expand our tolerance for volatility. It allows us to embrace high-growth tech assets in this chaotic AI era while maintaining a sense of security you can actually feel and touch. If all that hasn't explained my choice yet, let me share some deeper, more financial engineering level thoughts. I want to be clear. This is just my personal strategy and is not financial advice. It might not be right for everyone. First, there's the maneuvering room regarding taxes. As many of you know, the distributions from covered call ETFs often contain a large amount of ROC, return of capital. Many professionals hate ROC, calling it eating your own tail. But in my eyes, ROC provides an incredible arbitrage opportunity. My logic is this: use the tax-deferred nature of ROC to leverage RRSP tax refunds. Because ROC isn't counted as taxable income in the year you receive it, it just lowers your cost base. It essentially feels like pre-tax cash. I can take that cash and contribute it to my RRSP. By doing that, I use the RRSP deduction to lower my other high taxable income for the year. This results in a significant tax refund during tax season. I then take that refund and reinvest it to buy more shares. Essentially, I'm using the time value of taxes. I'm taking money that would have gone to the government and turning it into compounding capital for myself. It's a perfect tax closed loop. This was supposed to be a long-term experiment in my plan, though my recent job loss means I haven't been able to fully validate its power over a full fiscal year yet. But that's just the appetizer. The real main course is the leverage power driven by cash flow. Many people think income funds are just about underperforming the S&P 500. If that's your only takeaway, you don't understand what cash flow really means. The greatest utility of cash flow is the ability to support leverage. Let's do some quick math. Suppose the S&P 500 has a long-term average annual return of 11%. If you have a $250,000 mortgage at a 4% interest rate, your monthly payment is roughly $1,300. Theoretically, you only need to invest $150,000 into the S&P 500 to have the 11% growth offset your mortgage costs. In this scenario, $150,000 is effectively leveraging a $250,000 debt. But why does almost no one actually do this? Because the S&P 500 doesn't provide a steady stream of cash. You don't feel the support month to month. Income funds solve this problem perfectly. In fact, my mortgage is supported by my portfolio. As Canadian interest rates dropped, I refinanced my home to pull out equity and invested it into income funds to cover the mortgage. Because of the interest rate spread, my monthly out-of-pocket cost only increased by $50, but I now hold a massive pile of income-generating assets. Someone might ask, what if the market crashes? I've planned for the worst-case scenario. Even if the market and the distributions both get cut in half from a cash flow perspective, the amount I have to pay out is still less than if I had never done the refinance and tried to pay the mortgage purely out of my salary. The deeper logic is that you can't stop the inflation caused by government money printing. Long-term, asset prices must go up while my debt is locked in, effectively devaluing every year. The same advantage applies to my margin account. I use margin very carefully. I only buy during market dips and then use the continuous distributions to pay off the interest and arbitrage the difference. This using distributions to feed debt strategy is extremely difficult to execute safely without a high cash flow fund. In conclusion, after saying all this, I'm not trying to prove that index investing is wrong or that income investing is the one true way. On the contrary, I still believe that for most, index funds are the best way to grow wealth. But the growth versus income debate never ends. I've noticed a trend. Many growth investors love to look down from their mathematical high ground to criticize income investors. Yet, you almost never see income investors denying the value of growth investing. Instead of debating abstract numbers, just look at what's happening in the real world. Income funds are exploding in popularity. It has reached a point where even the most conservative institutional giants like BMO have been forced to pivot. They've launched entire series of target cash flow units specifically designed to lure investors back. When the biggest bank in the ETF space starts re-engineering their core products just to provide a steady monthly check, you know the market has shifted fundamentally. To some, this dramatic pivot in investor preference is something to be mocked. Critics might call it short-sighted or say people are just yield chasing. But I see it differently. This isn't about being short-sighted. It's a direct reflection of the deep-seated economic anxiety of the AI era. In a world where your job security can vanish overnight due to an algorithm, the desperate craving for guaranteed, predictable cash flow isn't a lack of discipline. It's a survival strategy. If you are a pure growth investor, then congratulations. It means you've adapted well to this era and your financial fortress is strong enough that you don't need immediate cash flow to feel secure. But I ask you, please don't judge other people's investment choices based solely on your own financial safety, because I firmly believe that finance exists to serve people and help them live better lives. It should be a warm, supportive foundation, not just a cold set of mathematical equations. I'm Oldfish. If you found this helpful, please like, comment, or subscribe. I'll see you in the next one.